Hi everybody, I'm Yohay. I'm Forex Crunch Market Movers podcast doing this special NFP report for FX Street. We'll do a rundown of this Nonfarm Payrolls report released on September 2nd, 2016 and talk about what's next for currencies for us. Okay, so what we'll do today is, of course, first of all, cover the details. It was a disappointing report, discuss the market reaction, covering charts of 6 currency pairs, and talk about what's coming up next. So let's talk about the data first. We had a report that in August, the US economy gained 151,000 jobs. That was less than 180,000 expected, also less than 250,000. That was sort of what was needed for a rate hike by the Federal Reserve on September 21st. Okay, also wages, the second most important figure, they rose only 0.1% month over month, lower than 0.2. And year over year, we had a setback. We already reached at some points 2.7. 2.6 was reported last time. This time we had 2.4, so we're in regression. Another disappointing figure was that the average work week that surprised with the rise last time fell down to 34.3. Other figures were not such a disaster if you want to be a bit more optimistic. The unemployment rate remained unchanged at 4.9. That's quite low. No change was reported in the participation rate. Steady as she goes, 62.8. And the revisions for previous months, July and June, were only 1,000 jobs to the downside, basically unchanged. So if you want to look at the bright side, the glass half full, the US economy is still gaining jobs. What was the market reaction? Well, you may have heard this term, Goldilocks. So it's the perfect combination. The economy is doing well, but there's no hike. As I'm recording this video, stock markets have opened in the US in a positive manner, and these reactions are also seen outside the US, in Europe, for example. The US dollar is, of course, lower, but the reaction is quite even. Let's look at the charts. So this is euro dollar. We were trading around under 112 before the release, and this is, of course, the action. This is the 30-minute chart. We went all the way up to 112.50, but then we fell back down. We're a bit above the pre-release levels, but never went too far. Lower support 111.30, higher resistance at 113.35. Pound dollar cable, we are here at 133.40, so pound enjoys it more. We had positive PMIs from the UK this week, so we had all these jumps during the week, and now the British pound is taking advantage of this poor NFP to rise to higher ground. The next line of resistance is 133.60, followed by 134.80. Support, well, around here at 132.40, and much lower support at 130.60. The pound enjoys the NFP much more than the euro. The yen is more like the euro. It made a move. That means dollar yen did fall a bit, went down towards 102.80 or something like that, but then it bounced back up, basically back to range, mostly unchanged, 103.60. Commodity currencies, we're starting with the Canadian dollar, they're doing really great. So dollar CAD is dropping as we speak under 130, further support 129.10, further resistance, further support to the downside 128.30, to the upside we have 130.80 and 131.40. The price of oil is rising in tandem. Remember, it's a positive report. That means the US economy is doing well, better global demand, but not enough for a Fed rate hike. We'll discuss a bit. We'll discuss that a bit later in a moment. The Australian dollar, it also is also enjoying the NFP. It went up. Well, it went above 76 at some point, but now it's a bit under this level. But all in all, it's moving higher. 76.40, 77.40 are lines of resistance. Support at 75.30 and 75. And last but not least, the Kiwi dollar. Well, it seems like yet another false break above this line of resistance of 73.30, but it's certainly a positive reaction. It's holding on to its gains. So resistance maybe 73.70 on higher ground, support at 72.60 and 72. Okay, that's a roundup of currency reactions. Now let's look at the wider scope of what's going on, continuing with the charts to explaining why no hike is expected in around 3 weeks' time when the Fed convenes. Well, the Fed is data dependent, and the data does not show that the economy is sizzling hot. The economy is okay, but remember, we had poor growth in Q4 2015, Q1 2016, and also Q2 2016. So Q3 is better, but we're not seeing any kind of overheating. Secondly, the Fed is dovish. They're always looking for an excuse not to raise rates. They want to go as slow as possible. And now they got their excuse. I mean, it's not an excellent report. It's below expectations. Wages are not rising. If the economy is in full employment, you would expect wages to begin accelerating in growth, to see more pay raises, okay? And another reason, they won't say it out loud, but the elections are coming. Clinton, which is sort of the incumbent instead of Barack Obama, does not want to see the economy choked by rate hikes. And Trump said he's a low interest guy, interest rate man. Anyway, the Fed would not like to intervene in the process. Okay, so if we're looking forward, what can we expect from markets, from currencies up ahead? So I believe we'll see an extension of the current moves. That means slightly weaker dollar, more against the risk currencies, alongside stock market gains, alongside gains in commodities such as oil, the king of commodities. Against other currencies, it could be a bit more complicated. Remember, the US dollar, the US economy remains the cleanest shirt in a dirty pile. The Bank of Japan is considering more easing. The European Central Bank is considering more easing. It convenes next week. The Bank of England, following Brexit, is also set to cut interest rates. So even if the Fed is going very slowly, the Fed is going in a different direction. But now that once the dust settles next week after Labor Day, I guess it'll be a bit more each currency to its own as we're seeing it now. That means if we have better data, for example, from Australia, the Australian dollar will rise regardless of Fed speculation. And the same if we have, for example, poor UK data, just examples. But what I'm trying to say is that we had a few weeks of focus on the US dollar. Everything went either up or down. And I think now we'll see kind of a breakup of these kind of correlations, and we'll see each currency to its own. Of course, this will change again once we get very close to September 21st. But for the upcoming week, we have the Labor Day weekend, time for reflection. So it's Monday will be a light day in terms of trading. On Tuesday, we have the ISM non-manufacturing PMI, but it comes after the NFP, so it doesn't carry the same weight. Something to focus on is, of course, the ECB meeting on Thursday. No changes expected to policy. The ECB is basically a bit helpless. They did all they can. Inflation is not rising. They want governments to do more. That will, of course, take focus, take the attention, will be in the limelight somewhere around Wednesday and, of course, Thursday when the event happens, and in the aftermath on Thursday. So I expect the focus to move away from the US dollar. In any case, remember that the Federal Reserve, convenes on September 20th and 21st. We'll hear from them on the 21st. And by then, they'll have time to give us some more information, a few more Fed speeches. I believe they will not give us any smoking gun, any clear hint about a rate hike coming in September, but they'll stress that every meeting is a live meeting and that everything can happen. Okay, so this is the quick roundup for the Nonfarm Payrolls. It was an interesting event. For me, the biggest lesson is that we have a breakup of correlations, a move away from the focus on the US dollar. 99% no rate hike in September. I will be very surprised. Sort of this buries some small expectations that we got after the Jackson Hole release. But remember, the US economy is still doing well. Okay, so thank you very much for watching. Hope everybody has a great weekend. Join the morning show on Wednesday, as usual, Wednesday morning, 7 GMT. I'm Yohay, Elam, Forex Financial Market Movers podcast, doing this special segment for FX Street. Thank you and bye-bye.